The biggest lie in trading is that the entry is the most important part. In reality, a mediocre entry with expert management can be profitable, but a perfect entry with poor management is almost guaranteed to lose. Most traders spend years obsessing over where to enter the market. They hunt for the perfect signal bar or the exact pattern completion. But once they are in the trade, panic sets in and the plan evokes chaos. Trade management is the bridge between a theoretical edge and realized profit. It involves three critical decisions: where to place the initial stop, how to adjust that stop, and where to exit for profit. Today, we break down this process using pure price action. We must begin with the trader's equation. Before you even click buy, you are defining a mathematical proposition. If your reward is twice your risk, you only need to be right more than 33% of the time to break even. The moment you enter, your protective stop must be in the market. In price action, this is rarely an arbitrary dollar amount. It is placed at a technical invalidation point, usually one tick beyond the signal bar or the swing point. If you are buying a high 2 reversal, your thesis is that the trend is resuming. Therefore, if price drops below that signal bar, your thesis is wrong. You exit immediately, not because of pain, but because the setup failed. Once the trade moves in your favor, the temptation to move the stop to break even is overwhelming. Novice traders do this to relieve emotional anxiety. However, this often destroys the mathematical probability of the trade. Market noise is normal. If you move your stop to break even too early, you turn a winning setup into a scratch trade. Price often comes back to test the breakout point before trending. The rule is to move the stop to break even only after the market has proven the new trend. This usually requires a strong breakout bar or a series of follow-through bars closing near their highs. Once that strong breakout occurs, the market structure has changed. The probability of a reversal decreases, and we can aggressively reduce risk. This is the transition from hope to ownership of the trade. Now, let's discuss profit targets. In price action, we distinguish between scalpers and swing traders. Scalpers seek quick profits, often exiting at 1:1 risk-reward. Swing traders hold for major measured moves. For swing traders, the measured move is the most reliable target. This projects the height of the initial leg or trading range upwards. It gives you a concrete price to place a limit order. A professional approach is to scale out. You might exit half your position at a measured move or resistance level. This banks profit and finances the risk for the remaining portion. Scaling out improves your psychology. Even if the market reverses, you have realized gains. The remaining portion, often called a runner, is held for a much larger trend potential. However, scaling out reduces your maximum mathematical payout if the trend is incredibly strong. It is a trade-off. You are buying peace of mind and consistency at the cost of maximum theoretical ROI. Now, let's talk about the opposite, adding to winners. This is how small accounts become large accounts. If the trend is strong, you enter again at pullbacks or breakouts. When you add to a position, you must adjust your stop loss for the entire trade. The stop for the new position and the old position should move to the new protective level. Never add to a losing position. This is the cardinal sin of trading. If the market invalidates your setup, you exit. Adding to a loser increases risk precisely when the probability of success is dropping. Managing the runner requires a trailing stop. The most common price action method is trailing below major higher lows in an uptrend. You simply hide your stop behind market structure. This allows the market to breathe. If the trend is healthy, price should not violate the prior major swing low. If it does, the trend is likely transitioning to a trading range or reversal. In a very strong breakout, you can trail your stop tighter, below the low of the prior bar. This is called bar-by-bar analysis. This is aggressive and used only during climatic moves. Sometimes, the market gives a clear exit signal before your stop or target is hit. This might be a reversal pattern, like a wedge top or a double top, signaling the momentum is gone. Do not hesitate to exit early if the premise fails. If you bought a breakout and the next bar is a massive reversal bar closing on its low, get out. Don't wait for your stop. This is adverse excursion. Price action is about reading the current bar relative to the left. If the behavior changes from impulsive to corrective or reverses, your management must adapt. What about getting stopped out? It happens. The key is analyzing if the setup is still valid. Often, the market stops you out and then immediately triggers the entry again. If you are stopped out but the trend structure remains intact, you can re-enter on a second entry signal. This is often a higher probability trade than the first, as weak hands have been shaken out. However, re-entry is psychologically difficult. You just took a loss. This is why position sizing matters. If your loss was small, 1 to 2% of account, you have the mental capital to take the next trade. A crucial concept in management is time. If a trade goes nowhere for 5 to 10 bars, the probability of a win drops to 50/50ths. In this scenario, exit at market or break even. Don't tie up capital in dead money. Let's synthesize this into a checklist. First, set the hard stop based on the signal bar. Second, identify the measured move target. Third, decide if you are scaling out or holding full size. Fourth, monitor follow-through. If strong, hold. If weak, tighten risk. Fifth, trail stops below swing lows. And finally, respect reversal signals. The goal of trade management is not to win every trade. It is to maximize the winners and minimize the losers so that the trader's equation works in your favor over 100 trades. Many traders fail because they manage trades based on their P&L, not the chart. They sell because they see plus $500, not because the trend ended. Learn to trade the chart, not your wallet. Remember, the market pays you to assume risk and manage uncertainty. If there were no risk of being stopped out, there would be no profit potential. Management is how you handle that risk professionally. To master this, practice replay mode. Take historical charts, hide the right side, enter a trade, and move forward one bar at a time, making management decisions before seeing the next bar. It is tedious, but it builds the muscle memory required to act without hesitation when real money is on the line. You are training your brain to recognize when to hold and when to fold. Ultimately, good management turns trading from gambling into a business. It removes the luck factor and replaces it with process. In the next video, we will dive deeper into advanced exit strategies and how to handle gap openings. For now, focus on placing your stops correctly and letting the market do the work.